Today, we're going to dig into the latest numbers from NetLink, the company that basically runs Singapore's entire fiber network. And honestly, when you first look at their financials, something seems a little off. It's a really interesting puzzle for anyone watching this company.
Okay, let's just jump right into it. On one side, you've got some pretty good news. Revenue, up 1.1%. And the cash they're actually paying out to investors, also up 1.1%. That sounds great, right? But then, you look at the other side of the coin. The official profit after tax is down. And not just a little bit, it's down by more than 10%.
So what gives? How can payouts go up when profit is going down? Are these numbers a red flag? Or is there something else going on under the hood? To figure that out, we really need to look past just the headlines.
And to do that, first, we've got to understand what NetLink actually does. Context is everything when you're looking at numbers like these.
Think of NetLink like the owner of Singapore's digital highways. They're not the company that sells you your internet plan. That's, your Singtel or your StarHub. No, NetLink owns the actual physical stuff. The fiber optic cables in the ground, the ducts, all of it. The telecoms just rent space on their highway to get the internet to your house.
So, where does their money come from? Well, this chart makes it super clear. Almost 60% of it comes from residential connections, and that's a regulated, incredibly stable business with really predictable cash flow. It's almost like a utility, like water or electricity, but for your data. This stability is pretty much the bedrock of their entire financial story.
Okay, so with that background, now we can get back to the big paradox we started with. Why on earth did profit fall when the business itself seems to be doing just fine? First, let's just double-check that top line. Revenue hit over $207 million, a nice, healthy 1.1% bump up. This was mostly driven by things like ancillary projects and co-location services. So far, so good. But then we get to this number, the bottom line, profit after tax. It came in at $43.5 million, and yeah, that's a pretty big drop of 10.2% compared to last year. This is the number that makes you kind of scratch your head.
And here it is. This is the whole story right here. The profit drop wasn't because the business is failing. Not at all. The main culprit is an accounting entry called depreciation, and it's all tied to a massive new investment they made, the Seletar Central Office.
So, let's break this down real quick. First, NetLink invests a bunch of money to build something new, something that will help them grow. Then, accounting rules say they have to spread the cost of that big investment over many, many years. That yearly cost is what we call depreciation. Now here's the key part. It is a non-cash expense. No actual money leaves their bank account for it each year. It just gets subtracted from revenue on paper, which makes the official profit look smaller. The reality is the actual cash the business is generating isn't touched by this at all.
So if that official profit number is a bit misleading, what should we be looking at instead? Well, to get a real feel for the company's health, you've got to follow the cash.
And for a business structured like a trust, one of the most important things to watch is the distribution per unit, or DPU. This is the actual real cash that they pay out to their investors. It tells you what the business can truly afford to give back to its owners.
And would you look at that? This chart tells a totally different story from the profit number we saw earlier. The DPU, the actual cash payout, has been climbing up year after year. That 2.71 cents for just the first half of the year puts them right on track to continue that growth. So even though the paper profit went down, the real cash payouts are still going up.
And hey, don't just take my word for it. The company itself points this out in their presentation. This isn't a one-time thing, it's a consistent track record. They've been returning more value to their unit holders every single year since they went public.
And what's holding all this up? A super solid financial foundation. Their debt is totally manageable. And get this, in today's world, this is huge. 100% of their borrowing is at a fixed rate. That means they're shielded from interest rate hikes, which gives them a ton of certainty. And this number really brings it all home. The cash generated from their day-to-day business was over $108 million in just 6 months. That makes it crystal clear that the core operation is incredibly healthy, totally separate from that accounting charge that dragged down the official profit number.
So, what does all this mean for the future? Let's take a look at what the company is saying about the road ahead.
They're pretty upfront in their outlook. They know that operating costs are rising, and that's a challenge.
They also know that big investments are going to keep making that profit number look a little funny for a while. But, and this is a big but, they also stress that their business model is fundamentally rock solid, and those big investments actually allow them to recover costs over time. So their ultimate focus, it stays exactly where investors want it, on managing costs and delivering sustainable cash payouts.
In the end, this whole story really boils down to a classic dilemma. The paper profit went down because they're investing in the future, but the actual cash being returned to investors went up because the core business is stronger than ever. So it leaves us with a pretty important question to think about. For a company that's building the infrastructure for decades to come, what's a better measure of success? Today's profit or tomorrow's growth?